Welcome to the STR Datalab.
Hello and welcome to another episode of the STR Datalab. I'm Jamie Lane, Chief Economist at ODNA, and I'm joined today again by my trusty co-host, Scott Sage. Scott, we're getting used to this, the two of us.
Look at that. Becoming a little duo here on the STR Datalab.
Yeah, and we're sitting here mid-August. I'm actually like 3 weeks into school for my 6-year-old, so what should feel like peak summer, and I feel like it is peak summer with our Barcelona office with everyone on a vacation, but it is summer. How's your summer gone?
Summer's going great here in SF. It's cold and
2
gray.
degrees.
Yeah. So summer comes later for us. But yeah, it was coming off the Olympics. Did you have a favorite Olympics moment?
Favorite Olympics moment was the men's 1500. Man, Corey Hooker coming back at the end and winning it. Man, that was exciting. And like the battle, like, oh, it was so good. What about you?
Definitely memorable moments. Steph Curry's last 3 minutes of the gold medal game.
Yep.
Memorable, and love to see that representing the Bay Area.
Yeah. And then it was so good. And for us, like the Olympics, we probably answered 1,000 press requests in the lead up to Olympics. Like, so at least professionally, like the Olympics was sort of like a thank goodness this is over, because it was such a big event in the STR industry. Airbnb was the major lodging sponsor. They had their event at the Musée d'Orsay. Like, they were there at the Olympic Torch. Like, they housed hundreds of thousands of people. Like, it was definitely an event of epic short-term rental proportions.
So let's start there. Why don't we start there? We got a lot to cover today, but you said it best. We did a lot of prep on the front end trying to predict what might happen around STRs in the Olympics. So what did happen?
Yeah, so according to our data, we showed that there were 743,000 total nights stayed in Paris during the Olympics, which is unbelievable. That's up
Insane.
90% year over year for the same 2-week period. So, and you look at sort of average numbers of guests in those properties, like that means over 2.7 million guest nights. Average length of stay was about 3.5 nights. Like, this was huge. And a big piece of this was that Paris was able to expand their supply. So we saw total listings up about 40%. But because of the quirk of Airbnb's regulations in Paris, where hosts have a limit of 120 nights that they can rent out their listings, we actually saw available nights up over 70%, 76% year over year. Because like, if you have it a unit and you sort of choose what time of year you're going to rent it out, like, of course you're going to rent it out during the Olympics. So this was great. Occupancy was about on average, about the same from the prior year, just over 60%. But where we saw the big surge was in the suburbs. So Saint Denis, northern suburbs, was a big host to a lot of events. So we saw a lot of people staying in and around the venues. So rowing, another one of my favorite events, was in the suburbs. So a lot of athletes and their families staying close to those venues as well, which for short-term rentals, like, there's not hotels out in the suburbs. So it really brings guests right into the action of being able to stay right near where the action's happening.
It's really cool when you just take a step back, right? And you think about the industry that we're in. This is like a macro example of what makes STR so special. These compression events. And that can happen as small as like a little neighborhood in a small town in the US, or it can be the Olympics with this grand scale. And I'm pretty sure of those nights stayed that Brian Chesky accounted for 14 of those nights, because every time I saw him on TV, he was from the Icon in Paris.
Yeah.
But I think that's what makes Airbnb and STR so special is the increase in supply to accommodate the demand for these large events, which is really cool. Now, speaking of Mr. Chesky and Airbnb, Airbnb just released Q2 2024 earnings. The Olympics was a key talking point in that release. But let's spend some time here and talk about what we saw. So on paper, if you saw nothing except their financials, you would probably say thumbs up, strong performance. We're seeing growth year over year, month over month. Yet the shares tumbled 14% after the earnings call. So what happened, Jamie?
Yeah. So yeah, high level, like things are still going pretty well. Like there's no sort of collapse in short-term rental bookings that maybe some of the pundits out there sort of calling for or really reacting to. Actually, in Q2, they saw a slight acceleration in year-over-year growth in nights booked in North America. So what the sort of all the hubbub was about was their expectations going forward. So they do expect a moderation in year-over-year growth in nights booked going forward. And they're a big piece of this is we're seeing shorter booking lead times and some signs of slowing demand in the US, and especially from US guests. So you think US guests, like for us sitting here in the US, like in the US, like domestic demand makes up about 85%. So for short-term rentals and about 15% from international guests. So that definitely has an impact on US performance. But for Airbnb, it actually has a big impact globally. As you look at just about every major country in Europe, they're number one are usually number two because usually domestic is number one, but usually their number two country for guests is from the US. And in some countries, even like, let's say Croatia, like US would actually be number one because domestic demand doesn't make up a big piece. So by seeing a slowness or some slowing demand from US guests, that can impact, and it has impacted sort of sentiment for their expectations going forward. So that is a worry. And it's definitely a worry for US or global travel in general if we expect to see US guests start to pull back.
And the other element I think baked within that we saw called out was this shortening of the booking lead time. And we saw Airbnb specifically make mention of that. That spooked some investors as well. Tell us how we should be thinking about that metric on a macro scale.
Yeah. And how I think about it is if guests, and there's two things that really impact your ability to book far in advance. And that's and really what we're talking about with lead times is how far in advance are guests booking. So one is availability of do you think as a guest that you're going to be able to get the unit that you want to book in? And for short-term rentals in general, we see lead times much longer than hotels. Because if you think just on average, like a short-term rental is a unique property that if you want to make sure that you can book that property, you probably need to book farther in advance than a hotel where there's maybe 200 rooms and each room's relatively the same. And like you could book a year in advance or a week in advance, and maybe you'll pay a little bit more or maybe even a little bit less a week in advance, but you're still going to be able to book that property. If someone else books that short-term rental before you, you've got to find an entirely different property, which for some people, like that unique property is actually what they want. And then the other factor is confidence. So are you confident you're going to take that trip? And in times of uncertainty, whether it's economic uncertainty, personal uncertainty, uncertainty around maybe there's a global pandemic happening that you don't know if you're going to be healthy enough to take a trip or whether there might be a lockdown, that can cause you to delay that decision. So right now, I feel like we're going through a period of economic uncertainty where if guests can, they're going to delay that decision. And also sort of backing that up is there's more availability in terms of listings, i.e. occupancy is down the past 2 years. So when you go and look on Airbnb and you see, okay, I've got 5 or 6 options that I could potentially choose from and be happy, like I don't have to necessarily make that decision right now. Where if you were doing that same search 2 years ago, like, oh man, there's like one option or maybe no options like that like I should book this now before it's too late.
Yeah, you might get a little FOMO in that scenario. I mean, I think as a host and as an operator, we're feeling this, right? I mean, I think if you see your booking lead times compress, you start to feel a sense of worry or panic, and that's natural because you're thinking you have a less likelihood of getting booked, number one, and B, if you're doing revenue management and practicing that, as the common schools of thought would suggest, is you lower the price when you get closer to the booking date. And so, I think we actually saw that in some of what Airbnb was saying, and we'll talk about that and what we saw in the July data. But I think that's a very real trend that we need to look out for, and may adjust how hosts and revenue managers manage price going forward.
Yeah. And I thought another sort of, and we'll sort of dive in that when we get into the US review, but another sort of call out in the Airbnb earnings. And I wanted your take on this as an operator and someone that was and managing a whole bunch of properties, trying to get direct bookings, managing through and your distribution through Airbnb, Verbo, Booking. But what Airbnb called out is sort of the growing reliance on smartphones and travel planning. So they saw a 25% year over year increase in app downloads and a now seeing 55% of nights booked coming through their app, which for me, like as someone that typically I think I use the desktop most of the time. And I know if I'm booking directly through someone's site, I'm probably using my desktop because most people's websites are not sort of meant for mobile use. And Airbnb released icons earlier this year. I think a big piece of that was like when you went to book an icon, you actually had to use the app. So they're getting more people sort of downloading the app. They're having the ability to sort of push people through to book through the app. Like, do you see this as like maybe something where Airbnb's building up more and more of their sort of and usefulness for hosts of that, and you can have an app that any guests and can book their property, and more people want to book it through the app. And like, unless you're going to build your own mobile app or mobile enabled website, like you probably want to be listed on Airbnb to get that sort of those consumer bookings, or are we all just going to have great mobile experiences as a property manager?
Yeah, I think there is a significant barrier to building a strong mobile site and experience, which is why it's a testament to Airbnb. Obviously, you come back to their first principles. They care about design, and they also care about making the transaction as easy and seamless as possible for both a guest and a host. And I think that's why you're seeing their intentional focus on mobile. Over half of their bookings are being completed on mobile. I'm sure they're thrilled with that and only want to see that number increase because of two things. One, it's an easier experience and it reduces friction to completing a booking. And two, it fosters what we talked about actually last time we talked about Airbnb earnings, which is the opportunity for community, getting more people on platform, more shareability via mobile, easier to text your friends, include them in messages, like they created the opportunity to do so when you're traveling now. So I think it's a testament to the work they've done and the focus they've done to make it easy to book mobily.
Yep. The other thing that we can't sort of talk about Airbnb without, and maybe talking about the broader ecosystem too, as we sort of lead up to talking about the US performance in July, is what's been going on with Verbo. Because Verbo is, and the second major booking platform, they had really bad performance last year and leading up into the first half of this year, where bookings were down and 10+%, as they sort of turned off their marketing engine with the sort of replatforming from the old Verbo ecosystem into the Expedia ecosystem. And in their Q2 earnings calls, they called out that they sort of went from negative to slightly positive from and sort of the spring into summer. So all else held equal, like you have Airbnb sort of performing really well, in part maybe because they were stealing some share from Verbo. And now this year it's like, all right, like Airbnb's still growing really well, but Verbo has gone from negative 10, 15% to positive. And when we sort of talk about overall industry performance, where we see US still performing relatively well on the demand side, and a similar slight acceleration that we've saw from Q1 to Q2, in part because of shortening booking lead times. Like Q2 is sort of getting into summer season, or in some ways peak summer season. People weren't booking in Q1 for summer travel. They were booking in Q2 for summer travel. But what we now see is, now that we're past that, like with the shortening lead times, that gets to be a bit of concerning of Verbo's back. People are booking shorter. Our visibility into the fall maybe isn't as rosy as we would expect it to be at this point.
I think that's well said. And maybe we use that, Jamie, to go recap July and talk about what to expect for the rest of 2024.
Sounds good. So high level, we saw total demand nights. So total nights stayed on short-term rentals this July up 8.3% compared to this time last year. So on the surface, like, that's great. Like, more demand, more people staying. Like, you cannot get mad about mid-single digits growth at this point in the cycle. Like, that's still very healthy. Overall supply was up about 6.5%, 7%. Note that is a slight acceleration from last month, where it was only up 5.9%. So I was super excited about that last month. I'd say I'm still excited about 6%, and it could be just noise in the data bouncing from 5 to 6%, but our expectation for full year growth is about 6%. So this is in line with the expectation. So that means occupancy was up 0.3%. Yay. Though average daily rates were down. They were down 1.3%. And we saw average revenue per available rental, RevPAR, down about 1%. Overall revenue was up. Our repeat rent index was flat, essentially no change in the average rate sort of charged by guests this year, or by hosts this year compared to last year. And then my favorite indicator, our nights book indicator, sort of that sense of forward bookings, still relatively healthy at 7%. So overall, when I look at our data, this isn't great, but it's good. Like, we're still seeing positive demand growth. With the shortening booking lead times, we are seeing a slight decline in ADRs, but not anything alarmingly so. And essentially, like, we're at what we sort of predicted at the beginning of the year of equilibrium. So not seeing significant declines like we did last year, not seeing significant increases like we did in 2021, but in this period of essentially flat. And yes, and we can dig into it, that there's some pretty wild swings of some markets doing really well and some markets not. But on average, the industry is doing pretty well.
All right, lots of numbers there. Let me try to extract a few insights and we can dig into them. So if we just take a step back, July had the highest number of listings ever recorded in the US, 1.7 million. Highest demand nights ever recorded. We're at 68% occupancy for the month, which is the strongest since July of 2022, and only about half a percentage point behind July of 2019. So that pre-COVID benchmark, that waterline there. We increased occupancy year over year. And by the way, that's 3 straight months that we saw occupancy growth. And as we look forward, we can expect a continued, I'll call it quote unquote, strong summer performance because of an earlier Labor Day. We'll dissect some of that going forward. But Jamie, I kind of hear in your voice a little bit of like tempered expectations, right? It's good. It's not great. Maybe we call this a B or a B minus if we gave it a report card. So help us understand where there's possibly some potential concern as we look forward or look deeper in this data.
Yeah. And one is when you look at a lot of the bookings, so nights booked up 7.5%. A lot of that is for July and August travel. So when we start looking further out and where things are pacing, like you start to see some weakness as we look really far ahead, especially on both the rate and demand side. So yes, we'll have the pull forward from Labor Day. And that's actually an interesting one of just the quirks of the data, and how the calendars lined up. But and we do want to and keep now an eye on fall and winter travel and holiday travel, and that people are actually booking that. So maybe not too cause of a concern yet, but it's just something that we're keeping our eye on because of the shortening booking lead times and our sort of visibility into that is getting cloudy. And you can't ignore that we've got a election coming up in November, and I suspect that there will be some people that, and with the uncertainty around the election, maybe and pausing, making plans around that.
Makes a lot of sense. Let's talk rates. So we saw rates hold steady or decrease across different markets this summer, with new listings priced slightly below market rates.
Yep.
Natural in this industry here. Repeat rent index, you said, dropped just about a couple percent, 0.2% in July. What are we seeing overall from a rate standpoint? Is this driven by the booking windows compressing? How should an operator be thinking about their rates strategy today and going forward?
Yeah. And what I hear from and quite a few operators, and you see this clearly in the data, is that people were trying to maintain occupancy and willing to give up a little bit of rate to maintain that. So you look at the areas that saw the biggest rate decline, it was in coastal leisure destinations where summer is peak season, right? If you're at the beach and you're not getting sold out during July, like your owners are probably not going to be happy with you, right? And maybe a part of that conversation with owners is, we want to make sure your property gets booked. You might have to give up 5% on rate this year compared to last year to make sure you get booked. But our rates are the highest they've ever been anyway. Like, are you okay? You're okay. All right, let's get your property booked. And I think that's a bit of what we saw. Small city, rural, we saw rate declines too on average, but and I still think that's probably a quirk of the data of just, and we see so much supply coming to that space still, and that's one aspect of the industry still growing 15% plus in terms of supply. That one, I don't get too worried about just because they're growing so much and there's still so much demand coming into it. But yeah, we saw a deceleration in rate in Mountain Lake 2 down about 1%, large city suburban down about 1%. And then where we actually saw an increase was in urban, where rates grew about 2%. And that's an interesting one, where we're actually seeing a pretty significant supply decline right now. Many cities implementing regulation. Um, a few implementing regulation,
A few big ones.
some big ones. Yep. And I would say performance in a lot of those urban areas still isn't where we'd want it to be, given at this point in the cycle, like still significantly below 2019 levels of occupancy. We see, and still to this day, urban operators going out of business. We heard just today that Marriott announced the signing with Sonder on a licensing royalty deal where they're going to be distributing Sonder properties through Marriott.com and their Bonvoy program. So, and why would Sonder do that? And they don't think that they can get the bookings themselves. So they're sort of reaching out to Marriott, hey, distribute our properties on your platform and we'll give you a percentage of our revenue to do that. So, and maybe they're throwing in the flag that they just don't think that they can grow the business in a way that they thought they could, and needing Marriott's help to do that and opening up access to all their properties and to business travelers that like to book direct and earn their points.
It's such an interesting deal, Jamie. I mean, I think it's a win, at least at face value, for Sonder, and it's pretty low risk to Marriott so long as the quality is maintained. But I think it underscores what we've historically seen in this industry, which is it's not impossible, but it is difficult to build that brand presence such that you can own your distribution channels. I think we've seen that with Sonder historically, and now they're sort of throwing in the towel is probably the negative way to say it, or actually The better way, or like the more optimistic, is inking this strategic partnership to go capture the Bonvoy members and go capture Marriott's audience base and distribution channels. And I think it's a really good play. I think, and you ask any operator, they'd love to be have access to Marriott's distribution network. So we are seeing some unique changes and creative thinking in the industry, and this is the latest example.
No, and I didn't mean that to be a negative, but, like, I see it as a win-win. Like, essentially, I guess like you do of, like, the only reason why they would do it is if they think the benefit that they get from distributing on Marriott is gonna be and offset the expense of them paying Marriott a percent of their gross bookings. So, they see that this is gonna be and bring pretty significant increases to top line revenue. They're able to sell more to business travelers at a higher rate and get people burning their points when they travel maybe overseas and stay in maybe major European capitals on Sonder properties. So yeah, and could be unlock the next phase of growth for Sonder where and we had seen them pulling back a bit in their search for profitability and that this gives them the sort of bookings and confidence they need to continue to grow again.
Spot on. All right, last topic, Jamie. Let's talk about what we're seeing from a macro lens. What should we think about here over the next quarter as we think about jobs growth, unemployment? We have an election coming up. What's the Fed going to do? A lot of variables. So, how do you crunch these numbers and try to predict what happens to the STR industry?
Yeah. So, man, it has been a wild month on the macro side, sort of following the numbers. We got, I'd call it a relatively weak jobs report last month. So the July jobs report, one of the lowest increases we saw in overall job growth, 114,000 out of the economy in July. Unemployment rose to 4.3%. And that spooked the markets. Like no way around it. Like, yeah, the sort of carry trade thing in Japan, but people were scared of that we're about to sort of launch into a recession. We subsequently have gotten some great unemployment prints in terms of how many people filing for unemployment insurance, essentially saying, you know what, like we're not in the brink of recession. We're not seeing a whole bunch of people sort of filing for jobless claims. We then saw the CPI number 0.2% on a month over month basis. We saw finally inflation tick below 3% on headline CPI for the first time. And expectations now are essentially, and that we're guaranteed a rate cut from the Fed in the September meeting. The biggest question is whether it's 0.25% or 0.5% that they're going to bring down the Fed funds rate. My expectation, if we're making guesses, is 0.25%. I think that actually scared the markets with going
Yeah.
0.5%. But I think that sort of is going to give sort of clarity that we are on this sort of downward path for interest rates, that we're going to start to see some narrowing of the spread between the 10-year and the 30-year fixed rate mortgage, which for everyone in this space of like, should I expect interest rates that are going to pay for buying a new property? Are they going to be coming down? Like, I would guess yes. And that is maybe going to start people maybe searching again for investments. That is going to start people at least becoming short-term rental curious again, uh, or at least maybe I expect maybe what a lot of operators don't hope for, because yes, there's going to be some lag between when interest rates come down and investment starts to pick up. Like it's probably a 6-month lag before we might see the effect of lower interest rates on more supply growth. But it's something to be keeping an eye on.
Got it. I think that's an important distinction is the time horizon between the flow through from when Chair Powell makes his interest rate cut to when we start to see an increase in supply in the STR space. But as always, Jamie, incredibly helpful and valuable insights here. Maybe the last question I'm going to leave you with in one sentence. What would you predict for August performance when we have this conversation 1 month from now?
Ooh, predictions for August. I actually think demand growth will be slightly higher because of that sort of pull forward of Labor Day. So we get 2 really high travel days, that were in September last year. They're gonna be in August this year. So that's gonna be maybe a slight acceleration. I think actually supply growth, active listing growth decelerates a bit. I bet we're in the 5% again in August, which will mean that occupancy grows yet another month. And who knows what rates are going to do. That's, I would say, the biggest question. Like, I would guess roughly flat.
Well, there you go. There's the prediction. We'll run the tape back 1 month from now.
Awesome. And Scott, what's your prediction and fun predictions? Who's going to win the presidency?
We'll cover that on the next episode.
Okay.